All right. So I hear a lot of traders talk about risk management. They talk about psychology. They talk about basic ICT concepts. But no one has really ever gone over what do you do when you have it all, right? I see a lot of videos talking about inversion fair value gaps, basic, very basic risk management. I see psychology stuff, which really sucks, by the way. And then I see a lot of people not be able to put it all together. And I feel like that's a very big issue in trading. Once you have all the information, a lot of people just kind of have a random collection of setups and ideas. And that's not what trading is, and that's not what trading's about. Trading's about consistency over time, letting time do the lifting. And having that consistency is only possible if you're being consistent in your trading. Now, that doesn't mean you're taking an inversion for value gap after liquidity is swept. That's not a model. That's incomplete. A model is made up of 7 really key specific things, and we're going to go over all of those. But a model is also not a guarantee that you're going to go into the marketplace every day and you're going to have a trade present itself. If the market doesn't present specific conditions, specific profiles at specific times, then you don't trade. And I don't really ever see any traders go over profiles. I don't see them go over when not to trade. I don't see them go over really that much proper things in general. I see a lot of people beginning developing novice traders forcing trades outside of their model because they don't have a specific thing to actually look for. And they think, okay, well, when I do have this specific thing and it loses, I don't know why. Well, why did this fail? Well, you're trying a reversal trade when we're at a consolidation. Or I'm trying a continuation when we're in a consolidation. Just very basic profiles that are never ever addressed because most of the traders in the space are scammers and don't know what they're talking about. But what I really want to go over here is what a model actually is. And a model is a very specific personal framework to you. And it's that set of rules that guides you into how you specifically approach the marketplace. We're not going in looking for a pattern, ignoring the time. Okay, it's New York Open, so it's time, right? We need very specific things that are personal to us. And you can trade my Cairo model. It presents itself pretty much every day. But you can trade anyone's model. Go pick someone's model. Go trade it. And chances are you're not going to have consistency with it. My Cairo model came from really when I was leaving support and resistance. I would trade MACD 9 EMA VWAP cross, and I'd be looking at the level 2 and time in sales. And I'd be shorting below lows and buying above highs, but I never was able to find true consistency. I had some trades here and there that were phenomenal, but by luck, by God's grace. And we don't want luck. We want consistent, high probability setups only. And what Cairo was, it's a way for me to identify, okay, we're breaking above this high. It looks like a shift in market structure, but we're not actually going to trade to that. We're not actually making a market structure shift. That's just being a turtle soup, and we're reversing lower. And I would never be able to identify why these things were taking place, and it would frustrate me every single time. So the model being a unique reflection of your personality, your risk, your lifestyle, builds confidence in itself on top of having to back test it and journal it like how I taught. That's really the main key to trading profitability. And when you have that confidence in yourself and that trading model, your own personal trading model, you become sort of immune to outside influence. Social media, friends, family, you have a girlfriend you want to impress, all of these things that trading psychology books never go into, those outside forces that just hit each other back and forth, and you can never focus on your actual trades. You stop caring about all that stuff when you have a model you know produces. When you have a model that repeats over and over and over again, and you know personally that it does, you start focusing on your approach, mastering yourself, mastering your model, growing in the process. And that building block of putting all of those things together that everyone regurgitates, the psychology, the basic, this is SMT, when most of the time it's not SMT. You need, good psychology, all of those things, actually applying it together. And you need that trading model in order to have any sort of, well, clarity in how you view the marketplace. I'm going in today, this is what's occurring. I see this, this, and this. How is my model going to navigate from the origin of that price move to its terminus, and in between, my model is going to align myself with that order flow? That's what a model is. That's a very different paradigm from, oh, well, here's a random inversion for value gap. Liquidity was taken all the way at the bottom of my chart, and so I can enter here, and I'll probably get it because it's probably going to that buy side. I hear a lot of traders talk about your edge. You need an edge. You need to push your edge. You have to use it while it's good. And if you ask them what the edge is, they're not going to be able to give you a definition. And if they do, it's going to be different from another guru. No one has one real definition of edge besides something that's personal to you. And that's what your model is. So this list is in no particular order. Everything on here is important, but the thing we're going to start off with are the market conditions. Where is price now? Where is it going? What has occurred behind us? What's the profile that we're going to expect? Are we going to be in a consolidation? Well, if we're in a consolidation, then I'm not taking a continuation trade. That immediately starts filtering out A+ setups for me, which allows me to preserve capital instead of taking an unskilled loss. And that's what a lot of traders struggle with. They don't have a system to filter out when to trade and when not to trade. So now let's take a look at some of those conditions. So that brings us into the New York profiles. If you're trading London, obviously it's going to be a little different, but I trade New York. So we're going to be looking at what has price occurred leading up to New York. Has London expanded? Has it put in the Judas swing so we can start expecting a New York continuation? Has it consolidated? Is there relative equal highs or relative equal lows below us from the previous sessions? All of those things are going to help us determine what we're going to be trading. So if we're going to see an expansion, very basic, very beautiful 2022 model, high time frame power of 3, hits the high time frame objective, market structure shift, 2022 model, Cairo, high time frame objective into the end. Basic core content. Reversal. Price leaves relative equal highs. Price moves lower, low risk buy, first stage, done. Right? Market maker buy model. Continuation. Like I said, if London comes down lower, puts in the low, takes out relative equal lows from an overnight session or a previous day PM session, and then price starts moving higher. We have a bullish high time frame daily chart. All of those things have to align for us, and then it moves up higher. Now, what we want to avoid is obviously a seek and destroy or a consolidation day. This occurs in a few instances, but the main focus is if overnight has a very large run up higher, and that overnight run, everyone's going to want to chase that. So if London session in Asia just shoots straight up, well, what's retail going to see? Retail wants to chase. They see, oh, it's going up, let's go up, we're going to miss the move, we're going to miss the move. It's New York Open, we're finally going to move because we're going to get good volume in, and then it either reverses on them or it chops them to bits. You see that after bank holidays. You see that if the high time frame draw was taken during the overnight session, all of those things are profiles. It's the basic, very, very just basic idea of how am I going to frame this trade? What's the narrative that I'm putting behind this? The narrative is not just, oh, well, we inverse this, so now we're bullish. Everything is coming from a top-down analysis, from a high time frame to a low time frame. Where's the weekly candlestick going to draw? Where's the daily candlestick going to draw? What's likely to occur? All of those things is what's required in order to have a high probability trading model. Last but not least, we have the economic calendar, which is going to be your roadmap for the entire week. It helps you identify what's going to happen before it happens, what news is coming up, how that news is going to impact the marketplace. So we open up with a really large new week opening gap on Monday. That new week opening gap is going to play a huge role for the rest of this week, where normally, because we have FOMC, part of the big three red news folders, CPI, FOMC, and non-farm payroll, we would expect Monday and Tuesday to be kind of a consolidation, seek and destroy, high resistant type days. So FOMC can set up a two-stage delivery and move higher because our draw is sitting higher on the daily. However, because we have a massive new week opening gap, that tells us that there's going to be volatility going into Monday. The massive new week opening gap, price is going to want to use that as a support level. So we know that even though Monday has no red news, which some people would say, well, I'm not trading that because there's no red news, but they're missing the actual narrative of what the market's doing. And a lot of people look for this legalistic approach to the market, but it's never going to be a one-size-fits-all. Everything's going to have its own unique situation, if you will, of here's the narrative, here's something that's a little different than how it was last time. How are you going to operate around that? And that's the experience part that someone just can't really teach. That comes from chart time, from back testing, from forward testing, demo trading, and then live trading. But with all of those things compiled together, we absolutely can know when to trade and when not to trade, when we're expecting large moves to occur. If that large move takes place on Wednesday and we shoot all the way up and we take our high time frame draw out, then Thursday, I'm probably not going to take a trade because the high time frame objective has been reached. So in most cases, once that weekly objective is reached, that week is going to be done, and you'll have either choppy price action or going into just a flat close of high resistance. And so when you are able to put all of those things together, it really helps build and build and build on top of confidence and on top of narrative, and it allows you to get rid of all of the bad trades inside of your model. And that's the key to long-term success.